me, I'm Chandler. Could I be wearing any more clothes? Maybe if I wasn't going commando. Whew. I'll tell you, it's hot with all this stuff on. I better not do any, I don't know, lunges.
Hey guys, Rob here from the Endgame Investor, and today we're going to go into a taper that's not happening, what happens when the trade deficit balances, some big things happening in GLD, silver backwardation day 4, platinum backwardation day 3, the Bitcoin to gold ratio collapsing, the silver to stocks ratio spiking, margin debt falling for the first time since COVID, and John Williams of the Fed chair saying that nothing is predictable, but he predicts very low inflation in 2022 and 2023. Let's get into it, shall we? So this is a chart of the Fed's balance sheet, and we know that from November 3rd, 2021, which is around here. The Fed announced that it would start to taper, meaning buy less bonds, meaning the slope of this line should start to flatten. Remember, flatten the curve? We all love that saying. Well, the Fed has not flattened its curve at all since November, so there has been no taper. Will there be a taper? Hey, I'm Jay Powell. Could I be buying any more bonds? Maybe if I wasn't going commando, I could back it with some gold.
Look at me, I'm Chandler. Could I be wearing any more clothes? Maybe if I wasn't going commando. Whew. I'll tell you, it's hot with all this stuff on. I better not do any, I don't know, lunges.
They said they're going to stop expanding the balance sheet in March, which is, 6 weeks away. Are they going to stop cold turkey? And what's that going to do to markets? It's not going to be pretty if they actually do it. Or they could just simply say they've tapered and stopped expanding their balance sheet and not actually stop expanding and just lie. And nobody will call them out except for us. And we're not on the mainstream media, so no one will pay attention except for the people that are actually paying attention. We'll see what happens. This cumulative yellow area here is the total amount of dollars that have been exported from the United States to abroad since 1992, when the trade balance was pretty much zero and trade was balanced. So this yellow area, if you add in all the years of all of that trade deficit, means dollars are exported and goods are imported in exchange for those paper dollars. That makes you in debt in dollar terms, but it also makes you rich in real terms, which is why the United States is such a rich country in real terms and so in debt. When this reverses, and it will reverse because you can't just keep stacking paper forever. Paper, money, any money, even gold, is used to buy things, and it has to reverse. The flows have to reverse. And when will they reverse? When the U.S. trading partners realize that they're going to get less and less stuff for the dollars they've stacked up in their central banks, they're going to start exporting them back to the United States, and the U.S. is going to balance all of its trade. It's going to look like very balanced trade when this is over. But that means that all those dollars are going to come back into the United States, and they're going to be able to import less from other countries. So they're going to have a flood of dollars and less stuff, which means prices are going to go way up. How many dollars exist since 1982 in total trade imbalances? 13,114,066,000,002. I added in that 2 just for the fun of it. Maybe there's 2 extra dollars. We don't know. But this is something that most people don't look at, don't pay attention to. But when it reverses, we will know that the end game is nigh. Third thing to notice this week is that the inflows to the GLD, the gold ETF, SPDR gold ETF, skyrocketed 890,000 ounces on Friday, just at the end of last week. That, if you look at this chart here with my little circles and my rectangles, that was the 11th biggest inflow into GLD ever. And the other ones were in 2008, 2009 during that sell-off bottom, and here in 2010 during the beginning of the final phase of the last bull market. And here was a top actually at 2016 at the beginning of the last beginning of this current bull market, which started in 2015. And here in 2019 was the beginning of the breakout from the 6-year trading range, and here now. So we have, these were bottoms. This was the beginning of the final bull move. This was a top. this was a bottom and breakout of a major trading range. So the chances are from history that this huge inflow into GLD signals a trend higher about to ensue. See what happens to GLD flows this week. Silver backwardation. This is a chart of silver backwardation. Here you see January 22 silver, which is silver for immediate delivery, which has settled at 24.314 on Friday, compared to February 2022 silver, which is still slightly below, which means spot prices are slightly higher than February futures, and it's been this way for about 4 or 5 trading days. It's not a major backwardation, but it is significant. We'll see if it continues. Platinum backwardation. Platinum is also in backwardation. You see here that it's settled January 22. Spot platinum settled at 1034.7, and you have 1034.6 in July. So spot prices are higher than July 2022. Futures prices, we have backwardation in platinum as well. It might be a good idea to go long platinum, but I wouldn't do it very heavily. I don't go beyond 1 or 2% platinum. It is too volatile for me. Now we know what's happening to Bitcoin. Bitcoin is proving itself, as it has always been, as a speculative asset. And when the price starts going down, the momentum always shifts downward. Here we have the Bitcoin to gold ratio, which topped out in 2017 at the peak of that bull market at around 16. And there was a consolidation zone at 16 here in 2021, and a test of 16 again at the 50-week moving average in July 2021. And here it looks like we are approaching that number again, but this time we are way below the 50-week moving average. This could be the end of Bitcoin as a major speculative asset. It will continue to exist, but it will not continue to attract the flows that it has, and the price will not keep going up as it has, because it is not an inflation hedge. It is not money. It is simply a mania. Here we have a silver to stocks ratio spiking. I mentioned this in previous videos. We have here what looks like a marginal break of a triple bottom. Bottom here in 2018, bottom here in 2020, and a marginal break. You see it poked a little bit below that in 2021, and now we have spiked up about to break through the 50 and 200 week moving averages. This could be the final bottom in the silver to stocks ratio. Watch out. This is exactly how gold stocks bottomed in 2015. There was a triple bottom that was marginally broken, and then gold stocks broke out along with gold. And by silver to stocks, I mean silver to the S&P 500 is what I mean. So silver priced in the S&P 500 has spiked up hugely in the last few days. Margin debt in trading accounts. You see here in 2000, during the dot-com bubble, it peaked out. In 2008, it peaked out at $400 billion. And here, this is the curve. We have here what looks like could be a peak at about $600 billion. And this is the first descent since that era began. Now, this quarter is going to be a much bigger drop considering what has happened in January so far. If it continues, obviously, in February and March, if we have a reversal, it won't. I have a feeling it will continue, but this margin drop is going to engender a lot of margin calls and a lot of forced selling if it continues to drop. Now, finally, I want to go into what John Williams, the New York Fed head and Fed vice chair, said in his latest speech at the New York Fed. These are quotes from the speech. Let's read them. Inflation in the United States based on the Personal Consumption Expenditures Price Index, the PCE index, their favorite inflation index, will likely exceed 5% in 2021. 2021 already ended, so he's just saying what we already know. And inflation rates are elevated in many other countries too, so he acknowledges that. Second, the circumstances we are facing today are unlike anything we've experienced in the past. Typical historical episodes cannot be used as reference points for current conditions. So he's saying there is no value to predicting anything where historical episodes cannot be used as reference points. And then he goes on to make a prediction. Just as the pandemic has followed its own script, I anticipate that the dynamics of inflation will also be different than previous cycles. With growth slowing and supply constraints gradually being resolved, I expect inflation to drop to around 2.5% this year. Based on what, man? Much closer to the FOMC's 2% longer run goal. And looking further ahead, I expect inflation to get close to 2% in 2023. These predictions mean that he's not going to vote for high rate hikes, and the inflation chase is going to be slow, and inflation is going to get ahead of them very quickly, possibly by February or March, I predict. He's wrong. We have had historical episodes like this where they print a lot of money and shut down production. It's called wars. In wars, you destroy stuff, meaning you lower the supply of goods and services, and you print money to fund the war, meaning you increase the money supply. And after wars, you typically get hyperinflation when demand returns. So this is a war. It's been a war. We know what it's been a war against. With inflation, final quote, with inflation having exceeded 2% for some time, the FOMC said it expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the FOMC's assessments of maximum employment. By maintain this target range, he's talking about the overnight Fed funds rate, interest rates. Now he's talking about maintaining the range. So he's saying he's not even going to vote for a rate hike. It's unclear what the Fed is going to do, but this is clearly dovish signaling from John Williams. We're headed into very sticky territory here. Looks like the Fed vice chair is denying that inflation will be a problem, or price inflation, consumer price inflation will be a problem. And it looks like GLD may have bottomed, and it looks like the silver to stocks ratio may have bottomed. It's going to be quite a year. Get ready. And you may want to sign up for a 2-week free trial of the Endgame Investor as I plot what is going on. Watch the trade deficits. If they start balancing, we will know that a whole bunch of Eurodollars, dollars offshore in foreign bank accounts, are headed back to the United States. And the money supply in the United States is going to explode higher, while the supply of goods and services gets choked off from a bunch of mandates and also prices rising abroad as the dollar weakens. It's not going to be pretty. Aside from getting a 2-week free trial of the Endgame Investor, you can also become my patron on Patreon, where you will get weekly videos of my commentary on the Bible from a liberty and Austrian economics perspective. If you value liberty, you'll value my commentary. Thanks, and have a good week, everybody.